Attention all hands. Stand by for an important message regarding VA loan assumptions. Are you a military family that owns a home financed with a low interest rate VA loan? Would you like to move to a new home but can't afford the high interest rate on your next home? If so, you'll want to hear about a unique feature of the VA loan program, the assumable loan option. Hi, I'm Lucian Valancourt, real estate broker and owner of Native Sun Realty here in Jacksonville, Florida. I'm also a Navy veteran who purchased my own family's home with a VA guaranteed home loan. In this video, we'll explore how assumable VA loans work, their pros and cons, and how they can benefit both buyers and sellers in a housing market with rising interest rates. But before we do, if you want to see more videos about real estate related stuff, then go ahead and hit the subscribe button and click the notification bell so you don't miss any new videos. For active duty military and veterans, I know buying and selling a home can be a challenge. Frequent moves and deployments make it difficult to build equity, which discourages home ownership. The VA, by offering the option to purchase a home with no down payment and favorable interest rates, allows more veterans to achieve their dream of home ownership after or even while continuing to serve their country. One of the most unique features of the VA loan program is the assumable loan option. An assumable loan means that a buyer can take over the seller's existing mortgage, including the interest rate and the terms of the loan. Since interest rates on home loans had been trending lower for many years, not much attention was paid to this valuable provision. However, since rates have risen sharply in the last year, assumable loans are now something to look into. For veteran home sellers, an assumable loan can make it easier to sell their home by transferring the low interest rate loan to a new buyer. This can be a huge advantage for sellers, especially in a market where interest rates have doubled when compared to the rates just 1 year ago. By allowing a buyer to assume their VA loan, a veteran home seller can attract more potential buyers, increase demand for their home, and thereby increase their home's value. So who can assume a VA loan? Basically, any credit-worthy borrower. You do not have to be a veteran to assume a VA loan. However, unless the borrower assuming the loan is also a veteran willing to substitute their VA loan entitlement, the seller's VA loan entitlement stays with the loan. The seller would not be able to use their VA loan entitlement to purchase their next home. In many cases, this is not a problem since most sellers will have built up enough equity in their home to be in a position to meet the down payment requirement on their next purchase. They would not need the zero down VA loan to finance their next home. If the buyer of your home is also a veteran, then they can substitute your entitlement with theirs and your entitlement would be restored. You could then use your entitlement to purchase your next home with a new VA loan or assume another VA loan by substituting the seller's entitlement with yours. In all cases, it is essential to obtain a release of liability from the loan servicer so you would no longer be responsible for repayment of the loan. This is very important because if the new owner defaults on the loan, then you can still be liable and your credit will suffer. So if you're a veteran seller, you're probably thinking, that's great for the buyer of my home, but how does it help me avoid higher interest rate on my next home? Well, now that you have sold your home, you've become a buyer. You can now assume another veteran's VA loan. Yes, even though your entitlement may still be tied to your previous loan, you can assume another VA loan just like any other buyer. As long as you are deemed creditworthy and approved by the current loan servicer, you can assume the loan as long as the veteran seller agrees to leave their VA entitlement to that loan. Let's look at an example to show you how this would work. Let's say you bought your Jacksonville home in 2020 for $240,000 and financed it with a zero down VA loan at a rate of 3.5%. You received PCS orders to Norfolk and now you have to sell your home. You put your home on the market in 2023 and sell it for $340,000. The buyer assumes your VA loan with a rate of 3.5% and 27 years remaining on the loan. The current prevailing rate for the VA loan is a 6.75%, so the buyer is getting a rate 3.25% lower than if he were to originate a new loan. Of course, this means that the buyer would have to come to the table with enough cash to make up the difference between the purchase price and your existing loan balance. This may sound difficult, but assuming the buyer has also recently sold a home, they're likely bringing their equity to the transaction and are able to meet the cash requirement. Now, back to you as the seller. You can also avoid a much higher rate on your new home by assuming a loan on your next home that is also financed with a VA loan. You can use your $100,000 gain in equity from the sale of your old home towards the purchase of your new home. If the home you purchase is at a similar price point, then your monthly payments would also be similar as long as the rate of the loan you are assuming has a similar rate. Let's assume the price of your new home is also $340,000, and the seller also financed the home with a zero-down VA loan with a rate of 3.5%. Let's further assume the seller also owned the home for 3 years and has a similar remaining balance. By applying your $100,000 gain in equity towards a purchase, your new principal and interest payment would be nearly the same. In effect, you would be transferring your existing loan to your new home. There are a lot of assumptions in this scenario, pun intended. The likelihood of finding another home for sale with the exact same terms as your previous loan is pretty slim. However, the benefit of assuming a VA loan is still there. You get to avoid a much higher rate on your next home purchase, which would keep your payments affordable. Closing costs are also lower on VA assumptions. For example, when a loan is assumed, it is not considered a new loan origination, therefore no intangible tax is due. There is no appraisal. There are fewer lender fees. The VA funding fee for a VA loan assumption is 0.5%, which is lower than the 2.15% for a new VA loan. So it costs less to assume a VA loan than to obtain a new loan. So the pros of assuming a VA loan are: buyers can save thousands of dollars in closing costs and appraisal fees. At 0.5% of the loan amount, the funding fee for a VA assumption is less than the funding fee for a new VA loan. Buyers inherit a VA interest rate that are often lower compared to what they would get on a new or different type of loan. When a veteran assumes a VA loan, the seller regains their full VA loan benefits. Buyers don't need to meet military service requirements to qualify. Now let's take a look at the drawbacks of a VA loan assumption. Lenders are not required to approve the assumption. It can be a more lengthy process. If assumed by a civilian, the veteran's VA entitlement stays with the loan. It's important for both the buyer and the seller to carefully review the terms of the assumption agreement and consult with their real estate agents or attorneys. Be certain that you fully understand the specific closing costs and financial responsibilities associated with a VA loan assumption. If you're a veteran home seller and would like to discuss the possibility of an assumable VA loan, then give me a call or send me an email. We'll review your situation and determine if it's the right option for you. If you're a buyer interested in assuming a VA loan, let me know and I'll help you find homes that may be willing to allow you to assume their VA loan. Till then, this is Lucian Valancourt with Native Sun Realty, helping you find your place in the sun.